Hey guys, so I've got Alan Schnur here. I've known Alan since, I think Alan, you and I met back in 2011. You were already just buying up half of Houston. So
Those were some exciting times.
those were very exciting times, and I mean since then you've had an even more interesting journey. Alan is an amazingly experienced, gifted deal maker, and we're going to talk about so Alan, that I want to kind of start at the beginning because you and I have similar backgrounds in finance and Wall Street and whatever it may be. But so I want to talk about how you switched paths and got into real estate. I want to talk about how you accumulated. I mean, at one point you owned 2,000 apartments. You managed, I think, 7,000 apartments plus. How many single family houses at the peak?
Oh, at the peak, we probably managed 500, 600, 700. And at the peak, I owned 300.
So you own 300 houses at the peak plus the couple of thousand apartment buildings. So I want to talk about how you got there because that's pretty freaking incredible. But what's more interesting is you've recently switched gears and now you're buying up retail strip shopping centers.
Can you believe it?
Which to me is super interesting. So now my first instinct when I saw what you were doing, I was like, well, that's interesting. Shopping centers, that seems very contrarian. Then I said to myself, well, Alan is phenomenally sharp. So if he's doing something, there's got to be a really good reason and really good strategy behind what he's doing. So I want to dig into that. But let's go back. Let's go back to the beginning.
Okay,
right?
So back to the beginning. I know we both have some history on Wall Street, correct?
Yeah.
And for me, when I finally started getting some breaks in life, I found myself working in the World Trade Center doing exceptionally well. Very fortunate. I was working on the 101st floor of the North Tower in the World Trade Center. And let's just say the morning business and the derivatives the markets that I was part of, it just always had to be there. It didn't matter if you were sick, you had to show up. And then it was a team sport. And I remember September 10th, 2010, 9/11. So yeah, September 10th. I know. So, I remember that afternoon, we were all getting ready to take a trip, 40 out of 44 of us, and the software product wasn't ready on time. And unfortunately, I was the only one out of the group that said, I'm going to go out to the West Coast and visit some of my customers and train them on the product, even though it's not complete. And then we all know what happened on 9/11. And I found myself waking up in a hotel room in Portland. Some of the traders were calling me, wondering where I was. Was I stuck in the building? And it was a very devastating day for me, and it was even more of a devastating, eye-opening week for me. The company that I worked for, Cantor Fitzgerald, we lost 700 out of 1,000 people. I lost 40 out of 44 teammates in my division. And I just woke up. I was stuck in that hotel room for a week, and I rewrote my life. I went, I just lost everything. All I really had left was my values, ideas, and dreams, because whatever was promised to me was quickly going away. I lived in Hoboken, New Jersey. The backyard was the World Trade Center. The train, the PATH train, right underneath the Hudson, one stop. It's all gone. So moving on. Let's move on. So I got my ass kicked. I lost my livelihood. I had to start over. I moved with the company to Houston. They gave it a few months and they pulled out. So I kind of found myself trapped in Houston. But look, the good news is I started reading about real estate. I had to rent that home in Hoboken. So I started understanding the rental process and working with tenants and collecting checks and taking care of other responsibilities. And look, I started going to investment clubs. I started listening to webinars and buying the books. And before I knew it, I joined the club. I bought a house. I fixed it up. I rented it out. And I made $50 a month profit. But you know what? The $50 a month, it's just, I have this rule in life. If you could do it once, you could do it 10 times. If you could do it 10 times, you can do it 100 times.
Yeah. And it was yours. You owned it. Yeah.
So, once I saw that I can actually make a profit at renting a house, buying it cheap, fixing it up, refinancing it, pulling the money out and doing it again, I did it 300 times. So,
Yeah.
So So me and my wife ended up with around 300 houses over like a 10, 15-year period. But what was interesting, so that's kind of one chapter of our life, okay? Kind of being the rehab or doing the flipping. But I was definitely more in the cash flow mindset, which we'll talk about soon. It's my latest book. You know, I always wanted to know that there's monthly money coming in because, you know, if you create something and you can rent it out, well, that's, you know, that's going to continue to pay you and pay you and pay you. But if you create it and you sell it, that's a job, right? We've all heard that. You know, that's an event. So, you know, I believe when you and I started to talk more was when I was just jumping into the apartment business around 2009, 2010. And if everybody remembers, the housing market was really, really getting crushed. But the commercial real estate market in the United States was not. And I kind of was scratching my head, you know, kind of feeling like, well, that's going to be the next foot to drop. So I started to scale in. And in Wall Street, we'll say I started to average down, right? Because I bought one of the highs. Yeah. But I remember the first deal that I bought, I probably paid around, like say $25,000 a unit. And it was a 76-unit deal. And then the next one I bought, believe it or not, I paid $12,500 a unit. So I almost caught the...
So I want to slow you down a little bit because to you it's like second nature to be like, oh, I bought 300 houses, bought a shitload of apartment buildings, but like to most people listening, that's an incredibly vast and long story. So I want to kind of go back. All right. So I've heard your Cantor Fitzgerald story, the 9/11 story before, and this is probably my second or third time hearing it, and it's still absolutely shocking to hear that story. I moved to New York in the aftermath, so I moved there in 2002. So I wasn't there for that, and I certainly didn't experience what you experienced, which is losing most of your coworkers, losing your job basically. But I mean, did that experience have sort of any more sort of profound, give you more sort of profound insights or epiphanies in terms of how to live the rest of your life? I mean, I would imagine probably something, I'm not going to say spiritual, but something probably incredible came out of that in terms of insights, right? Right.
So when I spent that week by myself in the hotel room, there really wasn't a lot of communication going on within the United States, and I really got like the inner look, and I really got to assess my life. And first of all, some of the things I came up with that day was I'm not a very good employee. So I've always been an entrepreneur, and I've always started my own businesses. And I was kind of baffled how I fell off course and ended up being an employee, you know, an upper level manager at a major corporation. So that was the first change that I was going to make. I knew I was going to go back and help and rebuild and then move on. And that's kind of exactly what happened. So I got back on course. So it was a real gut check for me. And yeah, I lost a lot of people that, you know, just kind of imagine one of your high school classes, just, you know, you're the only survivor out of one that you really liked. And, you know people, you love people, and you have these crazy, wacky, wild experiences with them. Look, we're all kind of young, running around Wall Street. And then they're all gone. It was a real team sport. So I was the only team player left on that team. So that was one of the major changes I made when I decided I was going to get back to my core beliefs and start building businesses again, which was one of the reasons why I did start buying houses. I also opened up some other businesses, but I think for this conversation, let's just keep it orientated. So I started buying one house a month. You know, that's kind of cool. Yeah. I bought one house a month for 10 years straight. And so, I kept it, right?
So now you buy a house, renovate it, put a tenant into it, then you would refi out, basically. That was your strategy. You would do one house at a time.
Pretty much. You know, I'm real big on team. I'm real big on building systems. I remember I had an agreement with my general contractor, which was, look, it's going to cost $5,000, $10,000, or $15,000. Don't tell me anything in the middle, right? I don't have time to slow down and, you know, to hear about your changes. That really helped the process because I did work. I was in corporate America. I remained in it, but I owned it.
Yeah.
So, the real estate was still part-time for me. I really believe in multiple sources of income. So I had my W-2 K-1 income from my job, my corporate job, but I also had that extra money from real estate, which I kind of call building my retirement. So I needed to I had a virtual assistant. I had a great title company that would come to me. I had a great contractor, and I had 1 or 2 property managers, depending on the count I had at the time. So I was able to really average around 1 house a month, 10 years straight. And then before I knew it, I had 150 houses and a real successful business. I started trying out all kinds of new software, and I figured out what worked best for me. And it was fantastic. It was very exciting. We're doing something good. We're cleaning up the neighborhood. We're creating safe housing for people. It was all kind of low income housing. Rents for like $600, $700, $800, maybe $1,000 a month for a 3-1 or a 4-2 bedroom in Texas.
Everything in Houston, right?
Everything in Houston. And some advice that I would like to give is, if you're going to build a housing portfolio like that, why not do it all in the same area? So if you go for a drive one day, you can see the majority of your houses. I know some other people here in the United States, or let's just say Texas, they own houses 100 miles apart. And if you got 2 problems and you're driving, 100 to 200 miles to solve 2 little problems on houses, the ROI is not going to be there in your time.
Yeah, it's much easier to manage, and I fully agree with your advice. I mean, most of my portfolio is in a single neighborhood, so not even in a single town, which from a management perspective makes it incredibly easy to manage.
And you know what, Daniel? Then you also develop a reputation in that area. People get to know you, and maybe even the local government. I remember there was this time.
you got. I read you got an award from the mayor for like, was that during the apartment phase, or was that during the single family phase?
It was there during the apartment phase.
Okay.
So I donated housing. People needed it, and for me, I guess I'm very modest. Wasn't going to even bring it up. But apparently they went around to many different organizations, and everyone just shut the door on them and said no. And I don't know if I was their first candidate, but I was the only candidate that said yes. And then before I knew it, they had me down in City Hall in front of city.
Like keys to the city, It
wasn't the keys. It was a certificate. But the mayor was giving it to me in City Hall. It was awesome. It was a good feeling, and I created better ties with the city here, which led to another opportunity, because there was a local bank that I didn't know that well. They knew I had a lot of houses in one particular area. And out of nowhere, they called me up one day and they said, look, we got, I think it was 24 or 25 houses. We just took them back from an investor. We'll sell them to you. It was really cheap. It was like $30,000 a house, 80% financing, 20% down.
Okay.
Before I knew it, I was closing. I called the Tokyo close because I was actually in Japan when they called. And I did this at the American Embassy in Tokyo. I bought houses. Yeah.
That's great. That's awesome. So now let me ask you this: you were buying through the upturn. I mean, you were buying through the upcycle, 2003 through 2010.
A lot of people don't know this, but I'm gonna apply some of my market knowledge, being part of the commodities and stock markets for 20 years. In early 2000, houses from HUD were cheaper than they were being sold during the crash of 2009, 10, and 11. I'll give you an example. I was buying, they had this electronic system. It was a software system. You had to be a broker. You had to have a special broker that can get on it. And Sunday night, we'd get on it, and we'd put our bids in. It was a silent auction. And, we'd buy houses for like $20,000, $25,000 a house. Now, I knew the land was worth $10,000, $15,000 a lot. And call it, $100 a foot to build. I mean, it was just so way in the money.
You're buying way below replacement cost. Yeah.
Absolutely. So then, they'd call us Monday morning and they'd say you get the house or you didn't get the house. If you were the only one bidding, you'd get the house. So I'm buying houses for $20,000, $25,000, $30,000 a pop. And that's how I probably got the first 75 houses. And I'm going to let you know, during the crash, they were controlling, HUD was coming in and they were really controlling the buy and sell, because they were, if anyone recalls, they were coming in, they were buying the houses, and they were even fixing the houses. HUD was actually fixing houses, and they were offering owner financing. So they were really trying to control the pricing, which didn't, as we know, in free markets, controlled prices never work. But I got to tell you,
so they were trying to build the floor, basically.
Yeah, absolutely, a floor and a ceiling.
Yeah.
So they were straddling. Well, yeah. So those prices were $50,000, $60,000, $70,000, $80,000 a house in early 2000. So maybe there was the beginning of a problem, and they were trying to get rid of them in the early 2000s. But then when the market flooded in 2008, 9, and 10, they had to make some serious choices. They could let everything just drop, you know, but they didn't want to do that. They held it up.
And so did that help your portfolio effectively in terms of
great question. So
because you held everything through the crash, didn't you? Or did you sell off before the crash?
And everyone who knew me was like, wow, you know, poor Alan. You know, but little did they know. But you're not. But here you are. You're not another cautionary tale, and that's why I'm also excited to talk to you, because we talk to so many investors now that haven't really made it through a crash like that. Right.
They're either a cautionary tale. Some of them wear like a freaking badge of honor now. Like, oh, I lost everything in the crash. I learned so many lessons. Right. I don't want to talk to those guys. I want to talk to the guy that made it through the crash.
Right. So let me tell you, because I had a friend that lost 1,000 houses, maybe 2,000 houses, and I sat down with him. You know, we always want to kind of interview somebody. I'm not boasting. Oh, look, I made it through. I want to know what you did that didn't work, so I don't make that same mistake. And I'll never forget, he told me that he took his time filling his vacants. And for me, when I get a vacant house, it's a cancer. We're going to get in there, and we're going to fix the problem, and we're going to fill it up. And so he took his time. So more advice to throw out there: fill your vacant house. A vacant house is dangerous. Insurance companies don't really want to even insure them. Fill them up. I always believed in dropping the price a little below market. I'd rather a full portfolio than trying to squeeze a few extra $100. Always worked well for me. And just to go back to finish your question about, what happened to me during the crash. Well, I couldn't buy any more houses because the prices were too high for me. So
you started just accumulating cash, basically.
I did, because if anyone, the rental market was pretty hot because nobody was really at credit freeze. No one could borrow money to really buy houses. And so, I mean, a lot of people got hurt, don't get me wrong, but the rental market, that was the beginning of what I call, like the Blackstone, the idea is like, oh my God, what's really happening here in America? Millennials aren't really buying houses anymore. They want to rent. Well, what about everybody else who just got ruined in credit and don't have enough money and jobs?
They don't want to be owners anymore. And
that was the beginning. That was the beginning of a rental spike.
How was your debt structured? You didn't have any. You didn't have any calls. You didn't have anything pulled from under you.
So a lot of people ask, how did you accumulate such a large portfolio? Because back in the day, you could only have 3 loans, 5 loans, 12 loans. They had all these crazy rules. But you get to a point where you start working with commercial lenders. You get away from the local banker, and the local banker will say, why don't you go talk to our commercial division? And that's what I started to do. And I was able to get blanket loans. And a blanket loan basically is, if you want to just take the analogy for what it is, take a blanket and pretend you can lay it over 10 houses.
Yeah.
So now you have all those houses on one loan, and it's considered a commercial loan. I would suggest if anybody does that, make sure they get release clauses, because I do believe in holding, but I have a flipping business too, and I'm constantly pulling houses out.
That's exactly. I've got a bunch of blanket loans. That's how we've structured, and we have a release clause in every one that lets me sell a house without having to go reappraise the rest of the portfolio, because
use the old appraisals, how you got in, for sure.
Yep. But now most of these commercial loans will have call provisions in them, right? I know during the downturn, a lot of those loans, I mean, you hear horror stories, right? Like even a loan that was current, somebody was making their payments, They found a reason to call the loan because now the bank was panicking, right? They were cashing in their chips. So I mean, none of that happened to you.
Here's what's interesting, and I know we're going to get into the commercial talk soon. That really happened in the commercial business big time. People were losing apartment buildings and people were losing their shopping center strips. But if you recall back in that time, there was a lot of arguing with the trickle down economic theory and who's getting the discount on money. Was it getting to the right part of the community, all these tax breaks? So banks were in trouble. They were in trouble because they were being accused of not lending. They didn't know which way to go. They were afraid of regulation. They were afraid to lend. So what the Fed government did, and they've actually always done, they just regulate it more now, is they give the bank, I believe it's some kind of federal credit when you lend to your community. So each bank needs to lend a certain amount of money to its surrounding community. So being in the single family house business for the bank, I'm sure your listeners and me, I mean, they're really looking for people like us because look, they'd rather lend to someone like me who owns 100 houses in one area, who obviously knows how to manage money and a good steward of money, than 100 individual owners. Right. So no call provisions for me. Matter of fact, they were trying to load me up on more stuff.
Great. That's awesome.
So I'll just leave this. We'll close this part out with, if some of the listeners see a local bank, they own a new one. There's only like 1, 2, 3, 4, 5 branches. They're looking for you. They need these credits to expand, to get more charters, and they can until they do. Yeah. So go knock on their door.
Absolutely. I mean, that's the only lenders that we use are local portfolio lenders. They're all commercial and they're mandated to lend in that local market, in that local area. They can't lend in a different state. They need to put money to work in the local market. So absolutely. So you're going to the recession. You've got 300 houses. They're all rented because you keep them a little bit below market rents. They're in good condition. You're renting to working class families. You didn't have class A super luxury high-rise type buildings, right? Single family houses, right? Single family houses are rented by working class people that need a place to live. So your portfolio is fine. Your debt's not getting called. Now it's like 2009, 2010, and you say to yourself, my life isn't complicated enough. I've got a job. I've got 300 houses. Let me go and buy just an ungodly amount of apartments, basically.
I like it. So, okay, I'm sitting in Tokyo, and this one bank sent me I wasn't even there for a week. I go there for sabbatical. I take a month or two off, and that's what I was doing then. And I'm not even there for a week, and I checked my email account, and this one bank wanted to move 25 houses. So, a Jewish white lie. I turned around to my family. And I said, I'm going to buy one house. Anyway, how do I get to the American Embassy? Because I can't read Japanese. And so, it was 25 houses. I mean,
you should have said, I'm going to go close one deal. Then you wouldn't have been lying.
Well, I needed you as a consultant back then.
I can be your Jewish lawyer. That's what I'm here for.
You were running around Croatia back in those days.
That's right.
So, okay, so I did it. So really, I did that. So we bought those houses. I went to the American Embassy. We talked about, and but it's interesting because that day at lunch, I'm in Tsukiji, it's a fish market down in Tokyo. It's great. So we're having sushi, and I'm sitting there. I'm like, how am I going to repeat that? Something happens so good in life. How the hell are we going to do it again? What do you do for an encore? And I'm just like, houses are over here, and I'm sitting in this restaurant and I'm just going like this. And I'm like, it just came to me. I'll go buy an apartment building. I know that's going to be the next big problem. Commercial real estate hasn't yet, but wasn't yet. And that day I went home and I got on loopnet.com and I started doing research in that area where I owned a concentration of my houses. And I found one. Started typing to the broker, and before I knew it, Call it 4 to 8 weeks later, I owned that apartment building. And that was it. That was the writing on the wall, because I know it sounds simple when someone says, look, do you want to own 76 houses or do you want to own 76 units under one roof? Right. And I knew that conversation. I had it in my REIA clubs all the time. But until you actually do it, you know.
There's a difference between intuitively or logically knowing something and actually being willing to execute it. So now your single family houses, you self-funded, right? You had a job, then you were refinancing out, you were pulling cash out. So you didn't have investors behind that portfolio, or did you?
No, I did it all by myself. And I mean, I was fortunate. I in a way, I over leveraged, right? I buy them so cheap. I fixed them up. I rented them out. You know, I might be into something for $30,000, $40,000, $50,000. And if the appraisal was coming in, I mean, back in the day, we can get, whatever. If I'm in it for 50 and it appraises for 150, I can probably pull out more than what I put into it.
Oh yeah.
Yeah. Watch my levels. I'm conservative so I just had enough working capital to just keep, ballooning that portfolio.
The good old days.
The good old days. But let's not give anybody an excuse not to do it.
Yeah, but it was on the single family side. It was easier, at that time, because you had that arbitrage that you could make between what your cost basis was and just a much higher appraisal.
We had reverse mortgages.
Right.
Did you imagine?
Bank paid you.
That's right.
Bank paid
like
you.
A credit card.
Yeah, it's incredible.
The principal kept going up. I paid $50 for the house. 3 years later, I was like, why do I owe $55?
It's because you pulled a ton of money out and bought like 5 more houses. That's why.
Right.
So that's not a bad deal. So you self-funded your houses. Now you're buying apartment buildings, right?
Right.
How much was the first apartment building you bought?
The first apartment building I bought was $1.7 million. It could be rusty, but $1.7 million, 76 units. I'm not pulling out a calculator because I want to stay with you guys. I think it was 20 or 20, whatever, something between $20,000 and $25,000 a door. Mm-hmm. But for me, the first apartment complex was increase my cash flows. I projected on a pro forma that I'd make $5,000 a month. Mm-hmm. Learn a new business model. I'm all about learning new business models. It's in my latest book. We'll talk about soon. Yeah. Okay.
Very, very nicely done.
You like that?
Yeah. We're going to talk about your books. I actually just ordered that from. So they have a free Kindle version on Amazon right now, but I don't have a Kindle, so I'm just paying the $25 for the paperback.
Well,
I'm a hard copy kind of guy. I like my books in hard copy.
Yeah, I like to take it in the bathtub, if you know what I mean. So for sure, I mean, I want to drop the Kindle. So,
no, but it's great because you often see books from people that have, questionable credentials, and you have an amazing track record, which we're discussing right now. So yeah,
let's stay with the track record. I do appreciate that, everybody. We're going to talk more about this. There's a few, and it's all about stuff we're talking about right now. Matter of fact, you're going to hear some of the stories that are in the book. Yeah. So we're talking about the first apartment building, and I went there every day for almost a year, and that's how I am. I didn't have to go there. I had all the houses behind me. Mm-hmm. But I was very curious. I wanted to learn a new trade, and I did. And
was it stabilized, or was it a repositioning deal?
It wasn't bad. It was actually an owner finance deal. I got into it. It appraised for $2.1 million, and I got into it for like $40,000. It was very exciting for me. I didn't realize I was going to get the credits back. I was going to get his taxes back. Some other refunds. I retraded him a bit on some things that were broken. And before I knew it, imagine controlling a $2.1 million asset with $40,000 down with the hopes of making $5,000 a month, $60,000 a year.
So the seller held back everything but $40,000. He held it as a note.
No, actually, he wanted out. He was a cosmetic dentist. He had enough. Thought that's what he wanted to do.
No, but I'm saying he seller financed everything except for the $40,000.
You're right. He seller financed it, but I really wanted to get the blessing of his bank, because that's not something you want pulled away from you, because I knew I was going to invest some rehab money. So he seller financed, he stayed on the note, and the bank knew what we were doing. And believe it or not, 6 months later, I decided to take him out, because seller financing.
There was a note, and then he seller financed this in second position, the rest of it basically.
No.
Was the note assumable?
The note was not assumable, but the same bank did a new note with me 6 months later.
Okay.
All right. So, but I could never have gotten into this deal if he didn't stay on the note. And I think he really just wanted me to bring money to pay for his closing cost. Mm-hmm. And so I owned it, and I ran it for a year. Didn't quite make $5,000 a month, but it created, sometimes there was a rule, let's get $100 a door or $50 a door. Yeah. A lot of that stuff is in here. Let's not get into the, the cap rates and expenses per unit and stuff like that. But it was exciting because I saw it, the house it's a great introduction to real estate, but it's mom and popping, right? Because who are you selling it to? You're selling it to mom and pop. I understand some hedge funds came in over the last 5 years. Quite frankly, I've never sold a house to a hedge fund, and I sold 100 houses last year. But I get it, right?
And it's only a few primary markets where hedge funds have really come into, right? I mean, if you're sitting in like a tertiary market,
right,
there's no hedge funds playing there. You are selling to mom and pop. You're selling retail, and you're valuing everything based on comps, right? With apartment buildings, it's much more clear cut. You get in, you raise the income, you've raised your value.
Right. You have your cap rates, you have your replacement costs. And you're right, raise the income, decrease the expenses. You're raising your net operating income, put it through a compressed cap rate. I don't want to lose everybody, but it's really exciting because
I love that kind of stuff. But I mean, we don't need to get super technical, but I do want to dig into how sort of you now went fairly quickly. You grew that portfolio. I mean, it was a matter of a couple of years.
So I had a joke. If I wasn't buying one house a month, I was a houseaholic. I had to buy one house a month. And I was an apartment addict. I had to buy an apartment complex every 90 days. And I did that for like 5 years straight. So that's how I got out to 18 apartment complexes. I hope that math equals. I think it does. So
carry the one. Close enough.
So, but the point I wanted to make was, when you start getting into the apartment business, you get closer to reinvestable real estate. And what I consider reinvestable real estate, it doesn't have to be a mom and pop anymore who's going to buy your multi-million-dollar asset. We've already explained that you're kind of on your own in the housing business. You're going to go sell it to investors or mom and pops. But in apartments, you might actually be selling to REIT, depending on the class you're buying. But you can also start selling to family offices that have a lot of money, and clearly you could sell to more sophisticated investors. Yeah. So that's what I like about multifamily.
So talk to me about how you scaled from a financing perspective, because you weren't reselling these buildings, right? I mean, at that point you were in the accumulation phase.
I was. So when I bought the first deal, I paid whatever. I got in light, so I bought it. They say you never make money in your first deal in life. So I did okay, but I didn't actually make a killing on that first apartment complex. But bang, 90 days later, what I predicted came, and now I'm buying 1 mile down the road, not $21,000 to $25,000 a door. I'm paying $10,000 to $12,000 a door. So
and what year was this?
Probably 2010, 2011.
So help me remember my market cycles.
Yeah.
Was multifamily taking a dive then?
Oh, it was the worst. Daniel, I bought stuff for $5,000 a unit. That's why I said averaging down. So I started at like, call it $25,000 a unit. 90 days later, I bought something for $12,500 a unit. 90 days later, I probably paid $7,000 to $8,000. My lowest price was $4,500 a door.
And what's that worth now? Where do you think that trades right now?
Oh, I know exactly.
50, 60?
For sure. Matter of fact, right now, Class C in Houston is trading closer to a 6 cap, where puts everything around $45,000, $55,000, $60,000 a unit. And I was buying stuff for, listen, there's rehab expenses. So some of them were really beaten up. So that's how I did it. I mean, that's how, like, that's what we learned in the housing business. The model. Let's buy it distressed, fix it up, fill it up, raise the income,
pull the money out.
Right? Yep. Well, and that really helped because the comps were so confusing to everyone out there. Once in a while, you get a really high appraisal because you got lucky and there was no foreclosures in the neighborhood. And I would pull out maybe $500,000 on a deal during the crisis. And then I would get online at an auction. And I remember this one deal. It was 160 units. It was in Pasadena, Texas. It was an auction. So it went for $2.1 million. I won the auction. I had to put down $210,000, 10%. Yeah, I had to put down 10. I had to leave a cashier's check there for $210,000, and then I had 29 days during the crisis time to figure out where I was going to get the rest of the money.
So what'd you do?
I got it. I found a local bank, and they believed in me, and I proved out the model. I proved out, it was a no-brainer. Matter of fact, we sold that thing. We're in it for 2-1. We didn't have to bring any rehab money to it. We sold it like 2 years later for 3.6. I remember the partnership made around $1.5 million, and more importantly, we paid out every quarterly. I'm a big believer in cash flow payments to my partners. That's how I built it.
So that's where you got into syndicating equity, right? As you started buying more apartment buildings, that's really the first time you had to bring outside investors in.
It is. Yeah. You're right. So good. I like where we're going with this. I probably did around 12 to 15 syndications over that time period. You know what they say about real estate? It doesn't matter how much money you really have or how wealthy you are. Sooner or later, you're going to run out of money for down payments.
Especially if you're buying on that scale. Yeah,
for sure. So I don't want to get ahead of ourselves. But last Friday, I just bought a shopping center. It's 115,000 square feet for $11.5 million. It's 35% down. So I had to bring $4.5 million cash. That would, if I was doing that all by myself, well,
it'd take you a little while to turn over some couch cushions.
Yes. So syndication. I'm a believer in it.
So was that a different mindset shift to make, right? You're used to bootstrapping, self-funding your equity. Now you're going out raising money. Was that natural for you, or was it difficult?
No, it was difficult. It was difficult because look, it's never easy to get up there on a stage or even a webinar, or it wasn't for me back then, and say, look, I need to raise $2 million here, and let me tell you why you should give it to me and why you should trust me, and how I'm going to make you money. I mean, these are big promises a syndicator makes to their investors, and I know we're a lot alike, and there's times in life where you're more concerned about other people's money than your own. So
it's a big responsibility. I mean, the flip side is, if you're a good person, then you are going to feel sad about it. You are going to worry about it because you're being a steward for other people's money.
Right.
So it's, that's how you know that their money's in the right hands, because you do worry about it.
So some of my best friends in the business, they refuse to syndicate, which therefore they refuse to grow because they don't want the pressure. They're good people. They don't want the pressure of losing someone else's money.
Yeah. And that's understandable. So let's talk specifics, right? You need to go out and raise money back in 2011, 2012. Now you have a track record. where did you go and find those people? I mean, did you get up on stage somewhere? I mean, let's talk specifics, because a lot of people that listen to our content, one of the hardest things that they encounter, right, is they may see deals that they want to do, but for most people, that's a huge mental roadblock. Like, who do I go and ask for money?
Right.
Where do I go and find those investors?
Okay. Okay. Look, we know they're probably going to pick up books and read about all this if they're already listening to your podcast.
Yeah.
But they have to go take action. Yeah. I mean, I guess as I get older and maybe more experienced, if I can tell who's going to take action, who's not. And when I mean take action, look, you got to go to your local investment clubs. I mean, you just have to go, because there's a lot of deals happening there. There's a lot of investors to meet, and you get out and you talk the talk, and before you know it, you're improving your trade skill as well. So I think it's very important when you meet somebody, hey, how are you? How you doing? You don't just say, yeah, I'm fine. You say, this is what I'm doing. I just got this property under contract. I'm so excited. I believe my investors are going to make an IRR of 14% annually, and we're going to return 8 to 10% cash flow. And just go through it, and you're going to get all these depreciation and the equity, and so it really has to become part of you.
Yeah.
I know. Look, it's a lifestyle. It's a lifestyle. People. I turn off, but this is my lifestyle. I enjoy it. This is my hobby. This is what I do for fun, and that's what your listeners should be doing too. They should go to the clubs. They should read books. They should practice their stadium pitch. Pretend you're just talking to somebody for 60 to 120 seconds, and get past them. Everyone says no right away, but just don't listen to it. Keep going, and before you know it, you're gonna get a few deals. You're gonna make some people money. You're gonna develop a reputation. Don't stop.
And it gets easier from there, doesn't it? I mean, after your first couple of deals you made, you did what you said you were going to do.
Right.
It became a lot easier to find people to partner with you.
Look, I mean, your existing investors. I bought a lot of apartment buildings. The investors, we talk about buying something cheap, fixing it, and then refinancing. During the refinance, you had the opportunity to give back 50 to 100% of all the investors' money. Now they're in the deal for nothing. I mean, they love it. Or just go flip the deal in 12, 24, 36 months. Look, I know we're getting a little ahead of ourselves, but the way you don't know this part about me, but after buying all those apartment buildings and having around 2,000 apartment units, the numbers seem small today, but I'll share the numbers. We bought around $50 million of apartment buildings, and we sold everything for around $75 million. So me and my partners made $25 million.
That's fantastic.
I got a lot of stories, a lot of war stories, but so it's not that hard for me to raise money, but sometimes it is, sometimes it isn't, but you got to start somewhere.
And it's a nice feeling when you are making other people money. I mean, you're securing their financial future. I mean, it's got to be nice.
Daniel, my best friend gave me, I want to say he gave me like 300. He hit some two incredible deals I did. He gave me 300,000, and I gave him around 1.5 million back. I mean, my best friend. That's amazing. Over how many years? It wasn't more than 2 to 3 years. It was just lucky. We caught the bottom. We really caught the bottom before we started to shift. Yeah. And bang, national money came to Texas, and it wasn't just selling to your next door neighbor anymore.
Yeah, that's amazing. That's awesome. So the downturn in multifamily didn't last very long. You got in. I mean, I feel like you almost timed the market pretty incredibly, right? Because that downturn, I mean, I know that by 2014, 2015, cap rates were getting compressed almost everywhere. Right. Everyone and their uncle was already by that point was hunting for apartment buildings. So, yeah. I mean, you got in just in that window where buying opportunities were incredible, and then your values just skyrocketed. Basically,
we were buying like 20 cappers. Okay, maybe no. Okay, I'm trying to fit the screen with my hands. And then you're right. So, our business model is, okay, sell it, make a profit, buy one again, and keep going and going and going. But when we started to compress to 8, 9, and 10 caps, it's really hard to buy a 10 cap that I sold at a 10 cap when I bought it at a 20 cap. So that was kind of, that was kind of an exit strategy for me to say, okay, keep selling. And you know how many apartment complexes I own now?
0.
1.
You still got 1.
I have 1. It's a great story. You want to hear it?
Sure. Yeah.
I bought it in the downturn, and hang on. Bought it in the downturn for around $1,125,000, which I think was like a 72-unit building, and I think that's $17,000 a unit. I did some minor cosmetic surgery to it right away, filled it up, and it immediately appraised for like $2 million immediately. So I pulled everything out, refinanced. I had no money in the deal. Cash flowed $25,000 a month net for like the last 7 years net.
Why would you let that go? I mean, that's incredible.
I have one partner on the deal, so I would get $12,500 a month. When I was more active into being on these interviews, I used to tell people, one commercial deal can change your life. Yeah. Because I bought a beautiful house, and that one payment from that one apartment building every month paid for my beautiful house. Yeah. Okay, so anyway, here the reason why I still kept it was because it just appraised for $96,000 a unit. So that was I think it's like $6.5 million. I'm blushing. I think that's like $6.5 million. That's phenomenal. And we've refinanced it 3 times. So my debt is like $4 million. And explain to everybody that my debt is now $4 million. We bought it for $1,125,000.
Right. It's a reverse. Yeah. It's. I guess it's kind of a reverse mortgage, right? I mean, it just kept going up and up and up and up.
Those old house loans.
So look, I wanna switch gears to your shopping centers, but before we do that, right? You were managing a portfolio of 300 houses, 2,000 apartment buildings, and that had to be challenging, right? I mean, you were managing that internally. You had a management company.
So what happened was I was doing a very good job at. I learned a lot of management through the single family houses, and I was doing a very good job at managing my apartment buildings, and then I was just getting reputation for myself. And before I knew it, I started taking on third-party reporting or third-party operators. Yeah. And I kind of said to myself, well, look, if this is how I'm going to spend my time, this is all I'm going to do, well, why not just buy an office building, hire a few employees, and, I'm all about building systems and expanding all the time. So it was working out great. And then I had the opportunity to take one property management company and merge it with my property management company. And in doing so, we became overnight 7,000 apartment units, over 1,000 houses under management, and some other assets, 225 employees. I bought a 55,000 square foot office building. So I had these grand ideas what I was going to do. We were probably in the top 10 size of management companies in all of Texas. Mm-hmm. But you know what? It turned out 18 months later that was not the right course of action for me.
Not exactly like a lifestyle business. I mean,
yeah, I got to tell you, I would never do that again. I didn't make a lot of money. The margins, management is a lose-lose situation. Let me tell you why. When it's not your stuff. If you're doing a great job, then what's the owner going to do? He's probably going to sell the asset.
Yeah.
And if you're doing a bad job, what's he going to do?
Sell the asset and then yell at you.
He's going to fire you.
Yeah.
So it's really hard to be in that sweet spot.
And the margins are, I mean, from everything I know about third-party property management, we don't do it. Like, we only manage our own assets, but margins are tight. I mean, you can make money, but you need to scale. You need to have really good systems.
Yeah, for sure. So I did it for almost 2 years, and I got out of it. But to answer your question, I had this joke: in order to keep my real estate, I needed to start a management company. So it's like,
you can't. Personally, I started my own in-house property management company because I just don't feel comfortable letting other people manage my stuff. Now, that doesn't mean that there's not good property managers out there. There are.
Right.
I just didn't want to have to go through 3 before I found the 4th.
Right.
Which inevitably I think is what would end up happening, right? So,
right.
So I get that saying.
It's tough to be in a business where 60% of your expenses are, we're talking about multifamily right now. Usually in like Class C, you're going to see 50 to 70% of your expenses due to things breaking and maintenance. It's a messy business to run, and the property manager has to make some tough calls, and the owners are never going to agree, and things need to be fixed. Which is why I got into shopping centers, which I'm sure we're going to get into in a second, because I found multifamily to be rewarding. I found multifamily unpredictable.
Yeah.
Until look, a P&L statement on a 160 unit could easily be 40 pages long, and there would be so many times where I'd go through these 40 pages. And maybe a water bill was missing, or commission check wasn't put in right, or the gas bill was missing. There was just so many variables that were just, taxes. I mean, my gosh, that's a whole nother conversation I'm sure you've had with other people. Now that the economy is great, we've gone from these horrific stories that we were talking about earlier. Now taxes are up 100 to 200%, but a lot of people live in these properties. It's a lagger. So, it might go up today, but that my tenant probably won't be there tomorrow. So it's kind of tough. So
and again, and you got out at the market. I'm not going to call it a peak. I'm not an economist, but you got out at a very good point in the market, right? So you timed. I mean, again, like I have to hand it to you. You timed it perfectly on the entry. Right? Where's my camera?
Yeah.
You timed it perfectly on the entry, and you timed it, I mean, as perfect as you can get on the exit. So let's talk about shopping centers, right?
Sure. So listen, I always believe in the velocity of money. I just like to keep it moving, and I have these, the rule of 72, and I think if you look for like 25% returns or something close to it, you'll double your money every 2 or 3 years. So I have 3 years indicators, which we'll talk about. A lot of them are in my books, but we're just talking about 60% expenses when that can easily be an expense in multifamily. It's just hard to say when you're syndicating, I promise to make you $100,000 when I can't control 60% of the property. I mean, the old joke in multifamily is, how do you replace plumbing when it's galvanized? 1 foot at a time with PVC. So, you just never know.
You're joking, man, but I've kind of done that. You mean you cut out?
I've seen you on Facebook. I know.
Cut out sections, or you're digging out the. So triple net leases.
Yeah.
Right. I'm sure you've got CAM reimbursements. I looked at one of your financials for a deal that you're raising money for now, right? So you've got triple net leases. For those people that don't know what that is when your commercial tenant signs a lease, it's often the triple net lease. They're responsible for their share, pro rata share of their real estate taxes, insurance, and maintenance, which is incredible because now if things break, it's on your tenant. And then I'm sure you also have CAM reimbursements, so common area maintenance. The tenants are responsible for their portion of like the parking lot and landscaping and exterior improvements. So you're taking a lot of variables out of your pro formas, essentially, right?
I don't know if I heard insurance, but I mean insurance. We just talked about doubling of insurance here in Houston on a lot of houses and multifamily.
Is that because of flood?
It's tough. So look, if you bought a shopping center and it's all triple net leases, well, look, I don't want my tenants to go out of business, don't get me wrong, but that's not going to change my numbers one bit, because that expense completely goes to them. Now they're making payments every month, but at the end of the year, if they're over or under, they're sending me a check or I'm sending them a check. And all I really have to do is send them a budget in Q1 of the following year of what we predict or what we're seeing.
So talk to me about like your typical tenant profile, because I think every time somebody hears now retail strip center, the first thing that comes to my mind is like, oh, you've got a bunch of mom and pop retailers. They're being put out of business by Walmart. They're being put out of business by Amazon. So it's a little bit, I think initially it sounds contrarian what you're doing, right? You're going to strip centers when a lot of those strip centers around the country may not be doing so hot. Now I'm gonna guess you're gonna say a couple of things. One, Houston is a hot market where people are moving to, right? And I'm also guessing a lot of your tenants are not your typical sort of retailer, clothing, books, that kind of thing, right? But I'm getting ahead of you. So talk to me about why you're going into that specific asset other than the triple net lease and all of that stuff.
Okay, so we talked about how the expenses are really controllable because you have all these triple net leases and the tenant's really going to take care of everything. Well, I always believed in being able to drive to my real estate. There was a time where I can drive to every single house where I live or every single apartment building where I live. So I don't know, maybe that's a control freak, but it was the expenses. It was scary. It was the expenses. So if I had a problem, I want to be able to drive to it. But we don't have that issue anymore with triple net leases. So it allowed me to diversify. We talk about travel all the time. It allowed me to buy stuff in other states. So you'd be surprised. The first few shopping centers that I bought, gladly, were not in Houston, Texas. So how cool is that? I get to diversify. I still have a housing portfolio, so I get to diversify my housing business, and I get to buy in other states. So when there's a Hurricane Harvey coming to Houston or something's kicking around in the Gulf, I'm not 100% exposed anymore. It felt great. I got to tell you, when that hurricane 6 months ago was out there, I had over a dozen shopping centers in other states that were doing just fine, and they were going to pay my bills if I got hurt.
And that makes complete sense. Is it an asset class that people aren't paying attention to right now? Are you able to get in? Is this going to be sort of a market cycle play for you?
So look, we have cap rates right now, right? And we've seen a lot of cap rate compression in multifamily where the majority of us seem to go. We're either doing houses or we're doing apartments. And everyone overlooks the retail industry. I have this story in one of my books, which is I was done getting my ass kicked at an apartment building, and I couldn't wait to get out of the neighborhood I was in because I would never go there in the first place. And I pull into a Starbucks. Starbucks just has such a wonderful way, making you feel like you're a first-class citizen.
Yeah, because you're giving them $10 for a latte, of course.
I was glad to do it because that's where I had another aha.
Yeah.
Why can't I be this guy that owns this place? Why not me? That's what I always ask myself. Why not me? I want to be that guy.
Yeah.
And it wasn't too long after that I bought my first commercial retail shopping center. And let's talk about the tenants. Let's really define what I buy is, how should I put it? Destination centers. Destination centers. And what I mean by that is I buy a strip. Let's talk about something relatively small because I bought a dozen of them, probably around, call them 10,000 square feet centers, okay? You're going to have dentists. You're going to have chiropractors. You're going to have a Subway. You're going to have a Papa John's, a Domino's. You're going to have an AT&T, a T-Mobile. I just put in an hearing aid company. I just signed up a Cellular Boost. I just signed up. So national names, okay? I'm not really going after the special D quick market store where you go get your 6-pack of beer and a pack of gum and cigarettes. That's not my business model. I want to be where there's a lot of traffic. So traffic counts are really important in this business. You know, personally, I look for like 30, 40, 50,000 cars a day that are going by. All right. So I like a lot of eyeballs. I like hard corners. So let me just spell this out too, because it's also a covered land play. So all of a sudden I'm on a very busy highway or a very busy thoroughfare, I should say. And I got a corner. You know, maybe that best use changes in 5 or 10 years.
It's interesting.
And when you can control the expenses, you really can predict the expenses you can hold.
Yeah, I mean, I'm looking at one of your offerings now, actually, on my computer, right? So it's a huge plot of land. It's 1-story shopping center.
Right.
You know, if you believe in density, right? If you believe that at some point down the road, 10, 20 years from now, you may be justified in going up. Maybe you get it rezoned. Maybe it's already zoned the right way. That could be, yeah, I mean, that's a great land play.
Right. So I want to get to that one, but I just bought that one last Friday. It's the biggest one. So maybe let's just go through a progression where I was buying like 10,000, just like the houses, the apartments. You know, we start small, we get big, right? So I'm just looking at my website, which is alanschnur.com, ALANSCHNUR.
Yeah, and I'll put it below. I'll put the website below the video on our site. Yep.
I'm just going to rattle some. The idea of what I'm talking about right now is to get the listeners comfortable and understand why I believe in retail shopping centers right now. Besides the fact it's the best it's the best value out there, right? We're value buyers, so I'm looking for the biggest bang for my dollar. My argument with this is I consider myself a housing expert, a multifamily expert, and let me ask you this question: if you can have a Starbucks, an AT&T, a nail shop, and a Subway sandwich in a shopping center on a hard corner with thousands and thousands of cars going by, and you can control your expenses, taxes go up, that's their problem. AC goes out, that's their problem. Someone throws a brick through the window, that's their problem. Hurricane comes, there's 10 feet of water, that's their problem. Insurance goes up, that's their problem. Okay, so now you have these 4 national tenants that have great reputations, and now we're going to go to a Class C apartment building in a tertiary market that has a demographic that just pay, you know, let's just call it rents are $500, $600, $700 a month. So now I'm going to compare credibility here. I mean, we know this from the markets. You know, credibility, credit worthiness is everything. So if something goes wrong in our economy, I mean, the people paying $500, $600, $700, $800 a month for their apartments, they can get hurt, and they're going to go away, and that's going to lead to a lot of vacancy. Now, that stuff is selling at a 6 cap, and I'm buying stuff at an 8 cap with AAA tenants. Yeah. So that's part of my argument, okay? I'm looking at my portfolio on my website right now. I'm looking at something that's in Colorado. It's in front of a super Walmart. There's a Starbucks there. There's a nail shop there. There's a Verizon there. I'm looking at a Taco Del Mar in Boise, Idaho. It's a whole strip there. There's an AT&T there. I'm looking at Wyoming. I got a Quiznos, a GameStop. I have a chiropractor.
I'm looking at your portfolio now. It's very cool. Yeah, you got a Radio Shack.
Well, so the Radio Shack's not there anymore. That's an old picture. But there's so much opportunity, and I can explain how we can make so much money. So when you buy a shopping center, it's sold on its NOI. So let's just say that NOI was $100,000 a year, right? Where you're seeing, and now Radio Shack, they're not there anymore. So let's just say they're 25% of the center. So now your collections or your net operating income is $75,000. Well, you just got a 25% discount on the center. And let me tell you something. That Radio Shack now, 2 years later, has an AT&T in it. So I've captured 25% equity, all right? Because I got a discount. It was vacant.
Because it was vacant when you bought it.
Right? Yeah. So we do this model. Oh, there's so much to say. It's so exciting. I mean, we buy stuff. I have 2 buckets. I have these formulas, okay? One's kind of clipping coupons, right? Give me the bond, give me the yield, send me my 8 to 10% a year. And I get that with my AT&Ts and my Starbucks. And then I have single tenant stuff we can talk about later if there's time. But then, you know, we like to gamble a little. Give me a center that's 50 to 70% vacant. Let me reposition it. Let me get in there with some fresh capital. Same idea, right? Buy it broken, fix it, leave it better than you found it, attract some new customers. Now, we can put in a nail shop, or maybe we can put in a Starbucks or an AT&T. We can put in a chiropractor, or maybe we can put in a Domino's Pizza. And the stronger the name, the more valuable the center becomes because it's more safety for the next buyer.
So let me ask you this: and it makes perfect sense.
Right.
What skill sets have you had to learn transitioning from multifamily to this? What's been the biggest adjustment in terms of, and I'm specifically asking in terms of due diligence, right? Deal evaluation, and then management, because these are very different assets, right?
Right. Okay. So sometimes I think we hear these jokes about God, or she, you know, God's a girl, or you know, God has a sense of humor. So I think maybe the sense of humor for me was put him in a few houses and make him sweat. And when he asks for more and you can't give him any more houses, well, then throw him into a few broken apartment buildings. and when he finally starts to do good with that,
right, you switch, right? Once you finally get good at something, you got to do something else completely. Right. But that's
no, I'm not done. I'm not done. Yeah. Then I proved myself. I kind of feel like I proved myself because everything that was thrown at me. I mean, 7,000 units. I mean, bodies in dumpsters to awful accidents to. I mean, it's unbelievable. Okay, so but then I get to this beautiful white collar, clean business where I'm having a conversation with Time Warner Cable or you know, a T-Mobile operator who owns 45 franchises across the South, you know. So it's a different conversation. It's a more enjoyable conversation. It's give and take. I'm learning a lot just hearing about their businesses. So some of the main differences are, like I just said, look, the P&L in an apartment building could be 40 pages, but the P&L on a shopping center, 1 page. You know how scalable that is?
Yeah.
So I like the scalability, and some other differences is management is not so intensive. Matter of fact, let's just say we manage all our stuff. My partners manage it. I'm just done with management. It's 3%, but you know, I let them take their 3%. I trust my partners. They manage it all. And leasing is really the most important part of this business. And one of the biggest differences between housing and retail is you're buying the leases. You know, we like to believe we're buying the leases in a Class C apartment building, but I don't know about you. You know, it's really hard to get your money if they don't pay.
Yeah.
In the multifamily house business,
it's easier to fill the vacancy, but it's harder to.
And then you have the turn cost, which is what kills people.
Yeah.
That's not necessarily. I have not had that problem. Actually, I take it back. I've had that problem once in like 3 or 4 years. I had a farmer's insurance go out and do whatever. The guy had no money. Other than that, I haven't had any problems. Matter of fact, sometimes they'll go dark, like an AT&T went dark, meaning they're not there anymore. They moved across the street because they built their own pad. They still have to pay me. So not only that, right before I rent out the space, I can do a buyout with them. So I'll get whatever they owe me at a discount, and I'll put a new tenant in there.
That's nice.
It really is. I'm really enjoying it. You got to get some good leasing agents. There's great property management software out there. I told you it's easy to run. It's so scalable. I mean, I'm in Wyoming. I'm in Colorado. I'm in Idaho. I'm in, where else am I? Of course, I'm in Houston. I'm in Prescott, Arizona. I'm all over in Phoenix. And, you know.
Has financing been more challenging?
Not Not really. I mean, we could talk about the deal I just bought last Friday. It was a big deal. It was $11.5 million. The deal appraised for $13 million. The life insurance company came in, gave us 7 years at 4.52%. And but they wanted 35% down, non-recourse.
Yeah, I noticed that.
Right?
But non-recourse, 35% down is a lot. Could you have negotiated that and gone in with less equity?
Yeah, I could have got 30% down recourse.
Okay.
So I don't want that. I mean, listen, non-recourse loans aren't what they used to be anyway. But
talk about that a little bit. What do you mean by that?
I mean, sure. When we were signing non-recourse loans in 10, 11, 12, it really meant if it didn't work out, you can just hand in the keys. And that's what propelled the whole downfall as well, because that's what people did. They said, you know what? Like I told you the story about the apartment building where it appraised for $96,000 a door, right? We paid like $18,000 a door. We bought it for $1 million and change. We now have $4 million of debt, which means we pulled out $3 million, right?
Mm-hmm.
It's a non-recourse loan. So if the world fell apart, I'm within my rights to take those keys,
just walk away
with my attorney and walk across the street and hand them back.
Yeah. After you've pulled out all that equity.
And that's what happened actually. I mean, it happens a lot. It's a real estate strategy and how to get bigger and bigger and bigger and bigger.
Yeah.
So we were talking about
but now you're
now.
When you're signing non-recourse loans now, what specifically is different?
Well, clearly, look, you could never intentionally do anything fraudulent. I mean, that actually would have triggered something back in the day too. That's a really good technical question, and I don't think I can do it justice by talking about it. I just want you to know, when I was reading my loan docs, I was kind of feeling like, you didn't exactly feel like you could wake up tomorrow and be like, you know what?
Right. You keep it.
Yeah.
You keep the building.
Right.
Okay.
So,
but you haven't found financing difficult. Insurance companies are in the market. I bet local banks would probably have financed these deals as well, right?
Yeah, they do. So
community
I have
banks.
a dozen smaller shopping centers,
Mm-hmm.
and it's all local. It's all local banks. It's all if the bank's out of Phoenix. I mean, I have property where banks are located at. They're my tenants, and they lend me the money to buy it.
That's great.
I don't even have an account with them. So yeah, it's all good.
And you're doing the same equity syndication model to get into some of these bigger deals, right? You had your 35% equity piece. I know you told me you and your partner brought a part of that equity in yourself, and then you raised the rest of it from investors.
This was a $4.5 million raise, and me and my partner brought $1 million to believe in it. The market is so hot. I can't even tell you how hard it is to even find this product to buy. But let me remind you and everybody, we bought a little over an 8 cap, so we'll call it an 8 cap. 50 to 60% of the center are national tenants. I mean, like Advanced Auto to Strawberries to, I don't know, just good names, So I can't control how they're going to run their businesses, but I can tell you that more than half of them trade on the New York Stock Exchange. So not bad tenants to have, especially if you're a bank or an insurance company that wants to lend money to a safer asset, right? So we kind of developed this saying, I don't know if it's ours, look, we're not trying to get rich quick at this point in our lives. We're trying to stay rich.
Yeah. You're parking capital, you're growing that capital at a good IRR that will let you double your money in a few years if it's managed.
So let me explain to you. So there's 20% vacancy at this at this center. It's 115,000 square feet. Go to the website. It's a big deal.
This is the Wood Forest Shopping Center?
Yeah. So just go under your current investment opportunities. It's 20% vacant, all right? If it was 100% full, it would have probably cost $13-14 million. But since it wasn't 100% full, we got to take advantage of that 20% vacancy, call it a 20% discount on the NOI, and we got to buy it at $11.5 million. So what's part of my pro forma? The first year, we have a slow lease up every 90 days So you get up to like 95%, and now we've just created all this extra value. So we've already just appraised for 13 million. So we believe once we fill everything up, it's going to be worth 14 or 15 million. And these aren't these massive home runs from the apartment days, but like I said, I'm not buying vacant buildings anymore either.
So I think there's probably still far less people paying attention than hunting for apartment buildings right now. So it's like you said, you can buy an apartment building at a 6 cap, right? That your income is completely unpredictable, or you can buy this at an 8% cap rate, and your pro forma is a lot more stable and predictable. I mean, nowadays when you look at an apartment pro forma, you know, it's like it's a crapshoot, right? I mean, it
really is. I mean, we're really like at an 11, 12-year high here. I'm not saying we're not going to go sideways for a long time, or I definitely didn't sell into that 10-year high either. I started letting them go, averaging up, average down, average up.
Yeah.
But I hope now, after part of this conversation, you're starting to see my point of view. Like when it comes to tenant credit worthiness, and you know, look, where I just bought this 115,000 square foot center, Amazon, this isn't the prime candidate where people order on Amazon Prime. It's not. I mean, there's fast food places in there. There's a CC's, a buffet for $5.99. One of the anchors has been there for 22 years. The other anchor is there for 15 years. There's 2 signalized lights. You have to stop. You can't get by my center going down this road without stopping. I got a school in the back. I got a school in the front. I got McDonald's across the street. I got Bank of America. I got Chevron. I got Walgreens. It doesn't go away overnight.
No, and Amazon is not going to put, you know, Advanced Auto Parts out of business, for example, or Title Max. Don't you have 2 sides of the road there?
I do. So I take up one huge side, and then the opposite side of the road is half the side. But that's where, look, if you're near a McDonald's and, you know, some of these main names, I mean, it's not a bad place to be. It's
Palais Royale.
Well, it's like
a clothing store?
An expensive Macy's. I call it an expensive Macy's. So, you know, it's like $5, $10, $15 schmatas, kind of like clothing and perfumes. And look, there's only 2 things to do in Houston. I hope I don't get in trouble here. You're going to go out to eat, or you're going to go shopping. That's it.
Right.
So
I like it. And guys, I'll post the website name because we're getting kind of towards the 90 minute mark here. So I'll post Alan's website name, address below. You can go to his website. You can actually check out this is not an offering memorandum. This looks like a package put together by the broker, or is this yours?
Yeah, it's a little of everything. It's mine. Mine might be up there. That's just about closed because we bought it. If anybody's interested, just send me an email and we'll talk. And if anybody, listen, I'm passionate about it. I hope it came out through this conversation. Not enough time to talk about everything from the development and out parcels and single tenant. Because I have a lot of warehouse. I'm doing ground up construction and storage. I'm doing ground up construction in 55 and older. I'm doing ground up construction in student housing. So I got my hands on a lot of projects, but I'm real passionate about this.
Yep.
Every summer, I take a good 4 to 10 weeks off. I travel the world. We live outside the United States. We spend a lot of time in Japan. And I pick a destination where I go by myself. It so happens in the next few weeks, I'm going to go
climbing. What did you say you're going? Everest?
Everest. So I'm flying to Nepal, Kathmandu, and we're gonna go to base camp. Okay, so let's not get ahead of ourselves. But
come on, Alan, don't be a wuss. Go all the way out.
All right. It takes like 50, 60 days. So
it's crazy. Yeah. And have you watched the movie? Have you watched the movie Everest?
Yeah. Don't talk about movies around here, please.
Because I watched that movie and I'm not coming anywhere near that mountain. So
yeah. So, but I like to actually get away and write down my thoughts. And I totally developed a philosophy on money. And I kind of broken it down to the millionaire mindset, the billionaire mindset, and the zillionaire mindset. It's all in here. A lot of the apartment buildings.
Hold it closer to the screen so people can see the title.
Yeah.
Yes.
A lot of the apartment buildings we were talking about. I use them as case examples here with real numbers. But I also just talk about my struggles on Wall Street and how I built my own firm and how I bought those houses and how I bought those apartments and how I buy shopping centers.
Yeah, you don't have to hold. Yeah, we got. And because you kept holding up as you were talking. So but I'll post a link to the book as well below this interview, so people will be able to access your website. They'll be able to order the book on Amazon, and then you're looking for investors. So I mean, if somebody's listening to this, and I mean, again, like Alan is one of the sharpest guys in the business. I think if you actually watch this interview, you don't need me to tell you that, right? I mean, he's an extremely sharp, responsible guy, and your model makes sense, man. I mean, that's one of the reasons I was curious to do this call with you, because I was like, I don't know anybody else really buying exclusively going out and buying retail strip centers, and you went heavy into this asset class, and I appreciate you explaining sort of your thinking behind it, because it does make sense. If you're not, if you're in the right place with the right demographics, and the right traffic count, I mean, there's a lot of advantages over owning multifamily or single family houses, or it makes sense. Yeah.
Right. But it's kind of interesting, because I have a lot of my former students and my friends that own multifamily. Yeah, we're always looking for the next thing, right, in real estate. So they're all, they're flipping out. They're doing 1031s into a shopping center strip, and then they're going to do some cost segs for massive seg. I better slow down. But it's a great hands off. I think one of the reasons why we don't hear enough about this sector is because, believe it or not, it's an older sector for older people. And because it affords us to slow down in life, because we're not handling all those alarms and fires and problems,
maintenance calls and issues, and and these are all long-term leases, right? If you have good credit tenants, they're long-term leases. I mean, you're just collecting checks.
They're like 5-10 year leases, and you'll get a good leasing agent, and they'll stay on top of it for you, or if you could do it yourself, even better. But you're just collecting checks. And I know one business model we didn't get to, and maybe we'll get to next, is the single tenant buildings, the CVSs, the Walgreens,
the Applebee's,
the Starbucks that stand alone.
Yep.
So there's a lot to that. Ray Kroc owned the land, sell them the franchise. But maybe we'll do it again. We can talk about that, because I own some stuff like that in warehousing, because warehousing is the darling right now of commercial real estate, because of where we are in the economy and our, people that, our president, and how they're trying to bring back manufacturing.
Yeah, I mean, I'd love to have you on for another call, because I think there's probably a wealth of other stuff we can talk about and we didn't get a chance to touch on. It sounds like you're doing about 10 other cool things that you didn't even really mention.
Yeah.
So I'd love to have you back on and kind of pick your brain again.
I enjoy it. Thank you. And listen, I've been a fan, and I figured out your software a long time ago. It helped me scale quicker, and I used it. And I know I might have been always asking you questions on tweaking it or send, but it helped me. And look, get started. It doesn't hurt to get started with houses. And if you're going to do it, it doesn't hurt to use software, right, to run your numbers and stuff like that.
Yeah. Well, Alan, that's awesome. I appreciate your time. Again, guys, look below the video. If you're watching this on YouTube, I'll post Alan's website in the description as well. If you're watching this on our website, there is going to be a link below the video to Alan's website, as well as to his book. Go check out his website. Do you have do you even do emails? Do you do an email list?
So listen, on the website, there's probably like 100 educational videos. There's some consulting stuff. There's my portfolio. The email address is alan@alanschnur.com. So drop me a line. I'm always building my industrialist. I'm always looking to learn the next new idea. Maybe you have a property you want some advice on. In a few weeks, I'm buying a 50,000 square foot warehouse in Arizona. Maybe you're interested in something like that, where it's just one or two national tenants. So,
or if you know of an off-market deal, right?
Yeah, for sure. We flip it, or we just come up with financing. You never know. You got to have the conversation. We started off the webinar with how do you get involved, and it's really taking action and getting outside your comfort zone. I don't just go kayaking or say I'm going to go climb Mount Everest for nothing. I mean, I'm always pushing myself.
Yeah.
So you need to do that in all aspects of your life, mentally, physically, but also financially, if you want to grow.
Yeah, absolutely. Couldn't agree more. Alan, again, thank you.
Thanks. Okay.
Tremendous interview. Really appreciate your insights.
Okay. All right. Lots of love to your little girl and your wife, and have a good day, everybody. I really enjoyed it. Thank you for your time, too.